Welcome to the Opening Bell Report.
Today we're reviewing a detailed financial analysis of Bitmine Immersion Technologies, BMNR, that's making a bull case for a potential 70% plus upside.
Right, based on its huge Ethereum treasury and a pretty big strategic pivot.
Exactly. So let's just dive right in and see how we can sharpen this analysis.
Let's do it.
Okay, so a key theme, I think, right off the bat is establishing BMNR as the, quote, microstrategy of Ethereum. The report does a great job making this comparison, highlighting the massive asset base, the 4.11 million ETH tokens, and this big net asset value discount.
And it's an effective hook, it really is. It gives you a benchmark that everyone knows to frame the scale of this thing.
It does.
I wonder, though, if we've considered the cost of that comparison. Because almost immediately, the report introduces Maven, the yield engine, and that fundamentally moves BMNR away from that simple holding company model.
Yeah, I felt that tension too. You hook the reader with this familiar concept, microstrategy, but then you immediately ask them to hold this other competing idea in their head.
Right.
That it's unlike MicroStrategy because of the active yield. Is the analogy worth that confusion?
Exactly. And that, I think, leads us straight to our first critique.
Okay.
The defining comparison to MicroStrategy requires a more rigorous analysis to justify the operational differentiation that's presented later in the report.
So the weakness is that the analogy is used for immediate impact. But then the report just pivots to the Maven launch and this promise of, what, $1 million a day in passive income?
$1 million a day. And that yield engine is the real differentiator. It's what makes it not MicroStrategy. But the analysis doesn't fully synthesize how BMNR is actually, improving on that model.
I see. So if the true alpha isn't just the asset base, but the fact that the asset base can generate cash flow, then the analysis actually risks obscuring the most valuable part of the thesis.
It puts a limit on it. You're defined by the comparison.
So what's the suggestion?
Well, the suggestion is to dedicate explicit, early analysis to that operational divergence. You have to use the MicroStrategy comparison as a launch pad, not a permanent label. Underscore the shift to yield generation right away.
You're managing the narrative. You want the reader thinking, this is MicroStrategy 2.0, not just, this is another MicroStrategy.
Exactly. You want to show how it addresses the weaknesses of a pure holding model.
Okay, so what would that look like in practice? Any concrete examples?
Sure. You could, for instance, restructure the analysis to move very quickly from the asset comparison to a new section, something like Beyond MicroStrategy, the yield engine advantage.
I like that.
And in there, you explicitly frame BMNR's strategy as a second-generation corporate treasury model. You focus on the mechanics, how Tom Lee's accretive ETH accumulation, plus the $1 million a day from Mavion, directly mitigates the holding costs that a passive holder faces.
That's powerful. It shows the reader that BMNR isn't just playing catch-up. It's building a more robust income-generating model. It changes the whole takeaway.
Right. It reframes the thesis from a simple discount opportunity to a discount opportunity plus a proprietary yield mechanism.
Okay, that's a much clearer value prop. Let's move on. The next big thing is the upcoming catalyst, this big vote on January 15th. It's about increasing the authorized share count from 500 million to 50 billion, a huge number. And the market liked it. Stock jumped 15% because it gives the company ammunition for expansion.
I agree, it's the highest stakes event in the near term. But that number, a 100-fold jump in potential shares, that's a massive, massive red flag for any serious investor.
It's a psychological hurdle for sure. 50 billion. You're asking for a lot of trust with a number like that.
You are, and that complexity around the dilution risk brings me to our second point. It's about structural integrity.
How so?
The report introduces the staggering 50 billion share authorization vote late in the structure, leading to an insufficient synthesis of the immediate dilution risk with the bullish justification for it.
Right. So the weakness is that this critical piece of information, the 100x increase, is presented as a catalyst. But the discussion of dilution risk is what? Compartmentalized way back in Section 5?
Exactly. It's buried in the generic risk section. An increase of this magnitude requires immediate context to manage the reader's anxiety.
So if a reader sees 50 billion shares but doesn't immediately see the defense against the dilution nightmare, they might just stop reading right there. They'll assume the worst.
Of course they will. The report is asking for a huge leap of faith without providing the safety net right then and there.
So the suggestion for improvement is to integrate the dilution risk discussion directly into the analysis of the big vote catalyst.
Yes. You have to use the structure to highlight the binary outcome here. The risk is neutralized only if the company executes its accretive ETH accumulation strategy flawlessly. It's not a generic risk, it's the core of the thesis.
Wow, okay. Reframing it that way as a structural element and not just a warning, that completely changes the narrative. It forces the reader to confront the critical point.
That success hinges entirely on management's ability to issue shares only when it's accretive.
Right, so concrete examples of how to do that.
Okay, so when you present that why it matters bullet point about giving Bitmine ammunition, you must immediately follow it up. Clarify the specific defense mechanism. You have to cite Tom Lee's explicit commitment to only issue shares when it increases the amount of ETH per share.
That's the key, that conditionality. So we're moving the focus from the potential for dilution to the risk of non-execution.
Precisely. You reframe it. Instead of a generic dilution risk, you call it execution risk on the accretive strategy. It's a much more sophisticated framing.
Okay.
Then you use the numbers to contrast the outcomes. The market wants the 50 billion shares for expansion, yes. But a failure to deploy that capital correctly, well, it immediately undermines the entire NAV discount thesis. That gap between the market cap and the asset base only matters if the per-share value is growing.
That makes the argument so much more robust. It shows you're tackling the biggest concern head-on.
Exactly. You're not ignoring the elephant in the room. You're explaining how you plan to manage it.
Okay, that's very clear. Let's move to the foundation of the whole thing, the valuation. The core mathematical argument is that BMNR is trading at a huge discount. You're buying $1 of Ethereum for about 55 cents.
Yep.
And this differential is presented as the primary driver for that explosive 54-plus price target.
And the math is compelling. I mean, the numbers are clear. 13.2 billion in assets versus 7.3 billion market cap? It's a huge gap.
But
It makes me ask, a gap that wide, is there a risk that focusing only on the NAV discount overlooks why that gap exists in the first place? Is there operational friction, a liquidity discount?
that's the challenge, isn't it? A sophisticated investor sees a discount that big and assumes there's a structural impediment. Just saying market lag might not be enough for them.
Not for the most discerning ones, no. And that skepticism, it has to be addressed head-on if this analysis is going to be bulletproof. Which leads to our final critique.
Okay.
While the net asset value discount is the core mathematical driver, the report could strengthen the thesis by acknowledging the real-world friction of closing that gap.
So the weakness is that the report proves the discount exists, convincingly.
Yes.
But it's light on the why. For a sophisticated investor, a gap this large implies an inherent, non-transitory risk that justifies at least some discount.
Exactly. It could be execution risk on the BMNR launch, or it could be a liquidity discount on holding 4.11 million ETH. You can't just sell that overnight without moving the price. By ignoring these possibilities, the report kind of weakens the conviction that the gap must close.
Right. So the suggestion is to preemptively strengthen the argument by acknowledging these potential counterarguments. You discuss the non-transitory reasons for the discount to enhance the belief that it will close once the catalysts succeed.
It's a rhetorical strategy. You show you've considered the pessimistic view, and you still find the opportunity compelling.
Okay, so give me some concrete examples of that. How would you phrase it?
You could introduce a brief subpoint within the bull case that anticipates the skepticism.
Something that connects the risk back to the operational pivot.
Absolutely. You could say something like, it is worth noting the current discount may reflect early-stage execution risk related to the Q1 2026 Maven launch. If this operational pivot is successful, the current gap is unsustainable. You frame the risk as the very source of the opportunity.
And what about the correlation to Ethereum itself? You said it's basically a leveraged bet on ETH. Does that warrant a discount?
It does, and the analysis should probably mention that. You could add that the high Ethereum correlation risk introduces volatility that might require a small permanent discount factor. Acknowledging that complexity makes the thesis more honest. You can still hit the price target, even if the gap only closes to, say, a 10% discount. It adds robustness.
This really elevates the analysis. It moves it from a simple calculation to a strategic recommendation that anticipates and neutralizes skepticism.
It transforms the report from just a bull case into a deeply analytical roadmap for the investment.
Don't forget to like, share, and subscribe for more.